Good day, everybody. Thank you for joining us today for what is our very first webinar for 2025. My name is Alicia Logan. I head up the membership department at Proudly South African, and I will be your host for the next 2 hours. Achieving financial wellness. What an apt topic, given the circumstances each and every one of us finds ourselves in. Almost all of us currently are reflecting on our holiday spending. And with every new year comes those resolutions. And I'm sure one of it is where we are looking at ways in which to make 2025 a financially stress-free year. Proudly South African's webinar, Achieving Financial Wellness in 2025, is really designed to equip consumers with, firstly, the tools and knowledge to recover from festive season expenses, while simultaneously allowing us to set meaningful financial goals and helping us develop habits that promote long-term financial wellness. Colleagues, during this session, we are joined by industry experts who will guide us on managing leftover holiday debt, building a sustainable budget for the year, that is 2025, cultivating saving strategies and ensuring safe online transaction, and of course, what we at Proudly South African live and breathe, buying local to create jobs as well as to strengthen the financial ecosystem. So Proudly South African members, families, individuals, and small business owners, let's look towards kickstarting 2025 with sound financial knowledge so that we can put together financial strategies that will aid us and guide us towards a fruitful 2025. As I confirmed, we have subject matter experts on the call today who have graciously and kindly given us their time to come through and really give you, our audience, their expert knowledge on how to really make your 2025 a fruitful, financially savvy one. Thank you to all of our guest speakers today. We really appreciate your time. And just before we get into our first speaker, I would like to give a little, short note on what I just, confirmed. Proudly South African really lives and breathes localization. The aim of our campaign, we are an advocacy campaign. And what it is that we do, we are advocating for every single person in this country, whether it be private sector procurement, public sector procurement, the general consumer. We are asking you to make a local purchasing decision. And, the very reason for you making a local purchasing decision is to buy local so that you can create much needed jobs in the South African economy. What is very important to Proudly South African is through these webinars, we educate the consumer on the importance of buying local. I think the logo on a product is not just a logo, placed there for Proudly South African's brand equity. The logo is a registered trademark that denotes quality and confirms local content. And every time we purchase a product with the Proudly South African logo, we are actually creating, whether directly or indirectly, creating jobs and ensuring a really good financial ecosystem. So, today on the call, as I said, we have subject matter experts, and they're going to guide you on, financial prosperity, and with that, I say to you that no transaction is prosperous unless we're making a local purchasing decision. I think that's the core of any, webinar or any call or any educational function, is that we need to be cognizant of localization and buying local to create jobs. So today, our first speaker is Casper Lagrange. Casper is a debt counselor, and Casper has over 15 years of experience in the industry, and he is registered with the National Credit Regulator since 2010. Casper is passionate about helping South Africans regain control of their finances. Casper's approach combines professionalism, empathy, and a deep commitment to ethical debt counseling. Without further ado, I will hand you over to Casper. Casper, thank you so much for joining us this morning. We appreciate your time, and we know that we're going to gain some really sound financial advice. Over to you. Thank you.
Thank you so much, Alicia. Yeah, I think in today's day and age, any South African economy is really dependent on local, on small businesses. And unfortunately, during festive season, we see consumers overspending. We see them not thinking of the long 3 months of January, but rather focusing on the then and now and the instant gratification, enjoying the time with family. And then we come into January and we've got all of these expenses in front of us, school fees, things for school, getting rid of debt that we accumulated during November and December to enjoy ourselves. So how do we address these things? We can't address any problem without understanding the problem. So we need to find out where are we coming from to know how to resolve those problems and steer ourselves to a prosperous future. So I'm going to give you some stats. And some of those stats, most of those stats come from our credit bureaus in South Africa. Just some nice to know info. There's 48 credit bureaus in South Africa. Most consumers don't even realize that. We all think, oh, there's only one or two. No, there's 48 credit bureaus in South Africa. And the data that's coming out there is showing us year on year, our total debt burden in South Africa, the total outstanding balance has grew by 2%. Now, that doesn't sound so significant, especially if we look at inflation. It's more than that. So, Casper, why is that a problem? Well, it is a problem if we look a little bit closer to that figure, and we say 40% of that increase is directly contributed to credit cards and retail credit. So that tells us that consumers are now starting to look at their basic living expenses, their food, their groceries. They are starting to buy that on credit. And unfortunately, overdue balances on credit cards are up by 9%, meaning people have reached their limits on these credit cards, on these retail credit. And how do they deal with it? Well, the only way to deal with it is to see where are we coming from, and how do we do that? Well, we go draw our bank statements. We start with the basics, and sometimes it is the basics that we all tend to forget. And I still believe in a printed out bank statement with a nice highlight, a pen and paper, and allocate every single expense that you've made, either for the last 3 months or the last 6 months. Obviously, the longer you take those bank statements for, the better idea of what your expenses are you are going to get. So common mistakes we get from small business owners is that they tend to blur the lines when it comes to personal and business. So for me, it's very important when we see consumers, as the first thing we try and fix is to to stop blurring the lines, draw the line in the middle, say, this is my personal bank account, this is my business bank account, and in my personal, I'm going to have a budget. In my business, I'm going to have a budget. So how do we get to that budget? Like I said, we're going to draw those bank statements, going to highlight every expense, and we're going to categorize them. We're going to categorize them in wants and needs for our personal side. So our needs, for example, is the groceries, rent, transport, school fees, all of those type of things. And then the wants is obviously the holiday gifts, the entertainment, the luxuries that we don't really need to survive, but it's the nice things we as consumers want. So once we've done that, we're also gonna categorize our debts and say, listen, yeah, this is my loans, this is my credit cards, this is my home loan, this is my vehicle loan, and we're gonna put that in a separate block. Another common mistake we pick up from consumers, they tend to see a credit card installment as that bare minimum installment the bank wants every month. So if you're only going to pay that bare minimum installment, it's going to take you 25 years to pay off that credit card. So in essence, you're just starting that vicious snowball effect on your debt. And that's why I always say a credit card is your gateway debt. That's the thing that's going to lock you in if you don't utilize it correctly. Credit card can be a wonderful thing if utilized correctly. So when you look at your credit card or your overdraft, you always allocate 10% of the outstanding balance as the actual installment when you draw up your budget. So now we've categorized our wants and our needs, and we've listed our budget, our debts, and we know now what is all our expenses. Now we need to look, does our income suffice to cover all of these expenses? And unfortunately, I know most of you out there just got to tell me, Casper, but my income doesn't cover all of these expenses. So how do we deal with it? Well, now that we know where we are in life, we're gonna see where we can cut back. And normally where we're gonna cut back is on those luxury spending. Sometimes we as consumers forget stopping at the garage for buying a Coke or that KFC or that quick takeout. We tend to forget that that adds up every month. And once you go through your bank statement, you highlight those things and you can put them in a block and say, okay, wait, maybe instead of eating out or stopping for a pint of Coke, I'm only gonna spoil myself once a week, twice a week, instead of every day of the week. And we see significant reduction in consumer spending once you do that. Planning on buying your groceries on a bi-weekly basis is a lot better, and having a list to attend to that grocery list. Now that we know and we've cut back on our luxury items, how are we going to reduce the debt part? Well, we've listed all our debt in the category, and we're also going to look at what is the highest interest rate. And we're going to start using the snowball method to pay off that debt. Starting with the debt with the highest interest, we're going to just push a little bit extra every month towards that debt to try and reduce it. Now, unfortunately, many South Africans aren't in a position, even after they cut their luxury expenses in the long 3 months of January, to be able to reduce those expenses or to reduce those debts every month. So how do we then deal with it? There is the benefit that the National Credit Act gives you as a consumer. So say, listen here, I as a consumer, I want to pay my debt and I want to be able to live. But if I do all those things, I've got nothing to live with. And what is the mistake that consumers make? They then try and alleviate the situation by taking on more credit. So I'm going to encourage consumers and you small business owners to try and make 2025 the cash only mindset. So we're only gonna deal with things when we can deal with them by utilizing our cash. So if you don't have discretionary income to push towards your debt, I really encourage you to go speak to a debt counselor where you can speak to them face to face and really go through your finances to help you alleviate those predicaments you sit or where you can't see where the outcome is. And people are scared. I know we're scared of the unknown, but addressing something now at the beginning before it completely snowballs out of hand is a lot better than waiting to lose your vehicle or house, or even worse, you need to close that business down because your personal debt has completely run away with you. So I want to encourage you today and reinforce the fact that you need to put a budget in place. You need to put pen to paper and put all your expenses, all your wants and needs, and all your debts in black and white that you can see this is my debts, this is my living expenses, and these are my wants and needs. Where can I cut back? Where can I allocate more money towards debt instead of taking more debt to settle other debt? All of these small changes can make a significant difference in your cash flow this year. And by alleviating your personal cash flow, it will take the burden off of your small business by taking less out of the business to deal with your personal debt. And by doing that, you can start creating an emergency fund, not only for your personal self, but also for the business. And how much nicer would it be going into 2026 with a nice financial buffer, not worried about the long 3 months of January, and you can smile. And I think the financial stress of today really has taken a toll on so many South Africans. And it's time that we deal with it head on. So these little tools or practical steps that I've handed you today is freely available on our website at ECGSA, and I really encourage you take pen to paper, print it out, write it down, then rather trying to use an app or just Excel sheets. Once you see as a consumer and you've written your living expenses and debts and incomes down, we really see consumers being able to make that difference in their lives. And I hope I've given you enough tools and encourage you enough to deal with your finances, that 2025 is not the long year that the long 3 months of January were, and that 2026 will be so much better for you as a consumer and a small business owner. Thank you so much, Alicia.
Casper, thank you so much. That was really great advice. Just something to add on to that. I think, changing really small day-to-day habits also helps. Yesterday, I, was in a conversation with some people, and they said that because we are such a digital, nation, and we literally on our cell phones and our laptops and our iPads every single day, what we're really missing out on is the broadsheets that give us specials on saving, and where you can save and the prices of goods. And I think, as much as that sounds, to most people who are really digitally savvy, that sounds so silly. Like, why would I then look at the newspaper and the broadsheets? I think that is where your saving actually lies. So, a little bit of changing habits here and there will really add to the bottom line at the end of the day. So thank you to Casper for that, for really some great informative advice. We move on to our next speaker, who is Marnus Mostert from Momentum. Marnus, thank you so much for joining us today. Just colleagues, just a little bit of a background into our speaker. He is a seasoned professional with over a decade of experience in the financial planning and consulting space, often featured in media outlets such as Talk 702, MoneyWeb, Business Insider, Business Tech, and Sunday Times, just to name a few. Magnus, thank you so much for joining us. I hand over to you. Thank you.
Thank you very much. And just to correct you there, I'm from Consult by Momentum, which is an independent financial advisory business. But thank you for having me, and I look forward to taking your audience through my discussion today. And the best way I thought to start with this is to tell two separate stories to emphasize the fact of why we need savings as part of our financial wellness. So person number one, it's not a client of mine, it's somebody that I met, but I'm quite familiar with the story. They own a farm. The farm's value is about 80 million rand. They've had offers in that region before. And at the moment, what they're doing is they're selling off farm assets, they're selling off machinery, they're selling off vehicles. And the reason for that is that although they sit on this very wealthy asset, with a large amount in asset value, they're not generating enough cash to literally put food on their tables. So that's one story. And now I'm going to jump to a more normalized story that I'm quite familiar with as well. Client after the fact, but what happened with them is that they had a family member that was very sick, that they were admitted to hospital. Sorry, can't you confirm if you guys can still hear me?
We can hear you.
Fantastic. Okay, the sick client, the sick member of the family was admitted to hospital to treat cancer. And although they had medical aid, they had cap cover. So technically speaking, they had all the right things in place. But what happened was each week that member of the family had to undergo CT scans, it was admission fees, etc. Now, those type of things you have to pay with your own cash flow immediately. You could only claim back at a later stage from the gap cover. So in this case, it didn't matter that the client owned a property, had 2 vehicles, had a large retirement annuity, had medical aid, had gap cover. He still couldn't afford all of the short-term payments to the medical provider. In essence, he went into credit card debts, personal loans, maxed out everything that he could. So I guess the story is that it doesn't matter if you've got a farm of 80 million rand, and it doesn't matter if you've got properties and you've got vehicles and you've got large pension assets. If you fall into any short-term type of emergency, such as losing your job, illness like we mentioned right now, something prohibiting you from getting your salary, etc., you need to have savings on the side. So I don't, in my view, it's really not a case of if you're in a senior or junior position, if you're rich, if you're poor, if you're old, if you're young, everybody from people starting out in the workplace to people who have already retired requires some form of savings to fall back on. Now, just to simplify this, what is the difference between savings and investments? So typically, savings is something you can put your hands on immediately. It's for short-term purposes, it's for emergencies, it's vacation, losing your job, pandemics, etc. We've all lived through those things. It's a vehicle, an investment vehicle where you can touch the funds immediately. In other words, it's liquid, it's accessible. Typically, those vehicles are your fixed deposits account, your money market, etc. Moving on to the investment side of things, just to move away from what is savings, investments is things that's 5 years and longer. It's long-term goals, it's your retirement, it's tuition for your kids. And if it's accessible or not, that's the funds that we don't want to use for short-term purposes. So in our mind, and truthfully, it should be written out and written down, these two things should always be split into knowing that this one is the one that's working hard for me over the long term versus the other one. It's okay if I've got an emergency and I need to tap into that vehicle of funds. And really, as I've explained with the farm owner versus your normal family that had a crisis from a medical point of view, I see a savings or an emergency account as the foundation that your wealth and your life is built on, because it gives you protection against some of the matters that we've already discussed. So it just alleviates that stress from yourself and the family, and it just keeps you overall financially sound.
Colleagues, I think we lost Marnus there. Let me just check if perhaps while we wait for him to rejoin the call, I urge you to also follow on social media. We're trending across all social media platforms: LinkedIn, Instagram, Facebook, Twitter, or X. So yes, you can also follow the conversation there. Can we perhaps move on to Mona while
Good morning. Can you hear me?
all right, yes, we can hear you.
Good morning.
Mona, can I maybe just do a short introduction quickly?
Sure.
Thank you so much for joining us this morning. Colleagues, Mona is a certified financial planner, an independent financial planner at that, currently serving as an advice specialist at Bob Bank. Is that correct, Mona?
No, Standard Bank.
Is it Standard Bank? Sorry for that.
Yes.
Um, so you basically work as a financial planner at Standard Bank. So when you say independent, what does that mean as opposed to just financial planner?
Okay, so I'm not a financial planner at Standard Bank. I'm an advice specialist, but I'm a
Okay.
certified financial planner by profession.
Oh, lovely. Okay. So you're a certified financial planner by profession, and at Standard Bank, you are an
An
advice
advice specialist.
specialist. Okay.
Correct,
So
yeah.
does that mean how does that work? So are you able to give clients advice outside of Standard Bank or only specifically to Standard Bank?
So how it works is I actually don't give clients, in my current role, I don't give clients advice when it comes to investments and the likes. I actually
Mhm.
work closely with financial planners who then advise the clients.
Okay.
Yeah, so my role is sort of coaching financial planners at the moment. The
Uh-huh.
only advice that I give is when it comes to alternate risk offerings that the bank makes to its clients, because we are then
Mhm.
licensed to provide advice in those segments, and then we
Mhm.
meet with the clients and advise them on alternate risk offerings.
Okay.
But currently my role is as a coach towards the financial planners, but as
Uh-huh.
a CFP,
Mhm.
I am able to give advice, but when it comes with regards to my contract at Standard Bank, that is not my role. Yeah.
Okay. All right. That makes sense. So your role is more an internal one. Um,
Correct. That's correct.
and the
Yes.
people that you coach those are your external, they deal with your external stakeholders.
Correct. Yes.
All right, that makes sense. Thank you so much for clarifying. I'll hand over to you and you can take it from there. Thank you.
All right. Thank you. Thank you so much for that. In this segment, I am going to be talking about budgeting. That is what I was asked to speak on. And I'm happy actually that I get to speak on the segment because budgeting is something that, as South Africans, when we look at the statistics, doesn't look like we do the greatest job at that. We've got high levels of debt to income ratio, especially when you look at how much we're paying month to month back. A lot of people are scared of the word budgeting because after speaking to some individuals, the perception that they have is that budgeting constrains them. And I don't want to feel restricted. So my topic for today is building a new year budget. And basically it's my aim for the end of this session is for hopefully all of you that are in on this conversation to gain insights into creating realistic financial goals, as well as a workable budget to stay financially healthy throughout 2025. So I think I'd like to start off by just looking at what the general rule of thumb is when it comes to putting together a budget. So there are three components that form a budget, generally speaking. You've got the wants. Okay, let me start with the most important. You've got the needs, you've got the savings, and then you've got the wants. So if everything was to be perfect and we looked at the general, what they call the budget rule, it's the 50-30-20 budget rule. And what that means is that 50% of whatever you earn go towards your needs. So this is your home, your food, your transportation, like necessities that you need for survival and that make living possible for you. That's where 50% should go to. And then 30% should go to your wants. So these are your nice to haves. For example, your Netflix, the gym, your vitality, going out on dates, going to the movies, anything that you can live without, but they just make life more comfortable. So you want to do with them. And then the third segment is your savings portion. And I like to believe that that is the most important aspect, only because it's the only of the three that invests back in you. That's the portion of savings. So savings is where you contribute towards retirement funds, contribute towards a long-term investment fund, or a short-term investment fund, if you can call it that, an emergency savings account. That is what the savings portion speaks to. And so ideally, what we want individuals, or how we would advise, not advise, but how you could look at splitting your income is 50% towards your need, 30% towards your want, 20% towards your savings. In my personal opinion now, I feel like looking at how the cost of living has increased, that may not be the most realistic way to divide your budget. So what I say is, when it comes to your wants and your needs, together they join to make up 80% of whatever you're earning. And so what I like to do in that instance is then you decide from that 80% how much you're going to split between your needs and your wants. But the most important thing to highlight, Jay, is you don't want to find yourself in a situation where you are living above what you're earning. And that's where a lot of people find themselves in. Ideally, I would say 60% should go to needs, 20% should go to wants, and then 20% at the least should go to savings. And one of the biggest mistakes that I see individuals make as they grow financially, because that's where you actually get individuals, is that the more you earn, you find yourself improving or increasing your lifestyle, and then your expenses increase. And oftentimes you find that the rate at which your expenses are increasing does not match the rate at which your income is increasing. And so you find people in a situation where they're over indebted, relying on their credit cards, relying on loans, relying on black tax. For those of you that are familiar with the term, it may be family responsibility to help you see through the month. And that is what we're trying to avoid. So some of the biggest mistakes that I find individuals make is, number one, you don't set a lifestyle ceiling. I don't think any of you on this call are familiar with that terminology. I may be incorrect, but you may be sure by the raising of your hands if any of you are familiar with the term lifestyle ceiling. Is there anybody that has ever heard of that term? Okay, I'm not seeing any hands. That means that no one's familiar with the term. So basically what lifestyle ceiling refers to is it's all about setting a cap for the lifestyle that you want. So you work or you journey towards this until you reach it. And this cap does not change with an increase in your earnings, because when you have set and stick to this lifestyle ceiling, then you're able to amass wealth. So for example, if you started working as a graduate and you started earning a salary of 10,000 Rand, let's say your ideal lifestyle requires you to be earning an after-tax income of 30,000 Rand. That means that there's a gap of 20,000 Rand until you get there. And so you find that every year as your salary is increasing, you are journeying towards meeting that ceiling cap. When you eventually get to the point where your earnings exceed that 30,000 Rand for your ideal lifestyle, ideally what we want is for you to keep your lifestyle there, 30,000 Rand every month. And then that means anything you're earning over and above that is going to amass wealth for you. So you're investing it, you're putting that away. And that is how wealth is actually built. When your lifestyle ceiling is here, your salary is here, and this gap is not utilized for once. It's utilized for investments, it's utilized to buy on properties, it's utilized basically to invest in things that are going to give you a return. So that's the biggest mistake people make when it comes to finances, is that they don't set a lifestyle ceiling. And so the more they earn, the lavish their lifestyle becomes, and the more indebted they become. According to Maslow's hierarchy, once all of the human's primary basic needs are met, so this is housing, food, transportation, what is at the top of the hierarchy is called striving for significance. And this speaks to self-esteem, self-actualization, you showing up the dream person that you see yourself. But it's in this mindset that individuals are caught in a rat cycle. You're never able to amass wealth because you're trying to keep up with the Kardashians. You're not investing back in you. You're not purchasing assets that will result in a return back to you. And that's the behavior that we're trying to change. Yeah. So back to budgeting. If you've never done a budget before, maybe you're asking, okay, how do I start budgeting? The nice thing about technology is that it's enabled us to have access to tools that make it easy for you to budget. Many of our banking apps already summarize what your monthly expenses look like. And so that gives you an indication of where your money goes if you've never done a budget before. So that's a good starting point. Going to your banking app, look at the savings calculator that's there, or calculation that summarizes what you generally spend in a month, so that you've got an indication of where your monies are going. And that's the first thing you want to do, understanding where is my money going. After doing that, you sit down and you make a list of all of your expenses, starting off with your needs. What are things that you need to cover every single month? Your rent, your car payments, your fuel, your food. If you've got maybe a professional membership, that would be included as a need because it's not a once. So you need to list everything, your airtime, start off with your needs, and then you put a cost that you're supposed to be spending a month on that. Then you move on to your wants. What are things that you don't need, you can live without, but they make life easier for you. So you want to keep them in. These are outings. These are Netflix accounts. These are buying gifts. You literally make a list of everything and you don't leave anything else. There's a saying that says modesty is a good thing. My personal view when it comes to finances is no modesty, just honesty. Don't be modest with what you spend. Be honest about where and what you spend. And so that's the first starting point. You list out all your expenses, and then you tally, what do my expenses come to every single month? Your needs, the wants, they combine. When you've got that, then you need to identify and separate the needs from the wants. That's a very important aspect. So you separate the needs, separate the wants, and then if you don't have an investment or savings portion, that's a good start. That's a good time for you to start. So you look at your take-home salary and you're like, you know what? I need to invest 20% of this. What does that equate to? If it's equal to 2,000 Rand, you then decide, how much am I going to invest in a retirement annuity? That's towards the time I retire. How much am I going to invest towards an emergency fund? Because you want to build that. And then how much am I going to invest in a medium to long term, maybe tax-free savings account or a unit trust? You divide that portion accordingly. And then once you've got all of that, you understand what your spending patterns are based on the budgeting rule that you want to apply. Remember, I said there's a 50-30-20 rule, 50% needs, 30% wants, 20% savings. Ideally, for me, it would be 60% needs, 20% wants, 20% savings. For you, it could look different. But just the memo is your needs and your wants should make up 80% in total. So whatever the split is for you, you just have to be clear on that. And once you know that split, then you group your expense items as such. This is how much I need to spend or I'm allowed to spend when it comes to my needs. Am I exceeding this or am I under budget or am I under it? If you're under, you're doing great. Give yourself a pat on the back. If you're exceeding it, then you have to look at your wants, your list of the wants, and you say, what from this list do I need to cross off? And you need to have that honest and open conversation with yourself. Okay, maybe for the first few months I can't have this, just so that I get my needs back on track. And then that's gonna help you to stop taking out unnecessary debt. If you are within the limits, as I said, well done to you, and ensure that you're saving too. That's like a very important thing. But if you are not, you need to relook at your life and you need to set a realistic budget. The big problem with individuals today in today's society is that we're not honest with ourselves when it comes to how much we're spending. And people don't want to have that discussion, whether it's with your spouse or maybe with your parents, if you're supporting them, or your siblings. You need to have those honest conversations, starting with yourself. Then the people that you're supporting or the people that are supporting you need to have that conversation. Sticking to a budget requires discipline. You don't always get it right. I'm a financial planner. Sometimes I don't get it right. But I think the one thing that I give myself a pat on the back for is that when it comes to the investing and saving portion, because I've set aside debit orders, that always goes through. And so you find the biggest problem is people are spending so much on their wants, buying new sneakers, going on vacations that they didn't plan for because a friend said, let's go here. And then you find yourself making use of credit cards when you shouldn't, taking on personal loans when you shouldn't, borrowing from friends and family members when you shouldn't. You need to come up with a budget. That way, instead of your money slaving you, you are mastering your money. That's what budgeting allows you to do. It allows you to become a master over your money because you're directing where it goes. The next step is for the first 3 months, you want to measure your expected outcome versus your actual outcome. So your expected outcome is I earn 10,000 Rand. I'm supposed to be spending 5,000 on needs or 6,000 on needs, 2,000 on wants, and 2,000 on savings and investments. That's my required outcome. My actual outcome is, okay, it's the end of the month or it's mid-month. What is my bank balance looking like? What have I spent money on? And you're going to see discrepancies. Where those discrepancies lies is where the areas that you need to work on. Those are the troublesome areas. And so you give yourself 3 months to highlight where are the challenges, the problem areas for you. And then another thing I like to say is get an accountability partner to help you and to encourage you. This can be your best friend. This can be your sibling. This can be your parents. This can be maybe a someone that you trust that won't take your information out. Get that accountability partner that you can be like, oh, I think I'm going a bit overboard, and let them talk sense back into you. And then lastly, make budgeting fun. It doesn't have to be boring. Set rewards for yourself when you achieve certain milestones. For example, you tell yourself, I'm going to build an emergency fund. And if I don't touch any of the amounts in the next 6 months, then I get to take myself to the one restaurant I've been wanting to go to. I get to buy myself that one item I've been wanting. Yeah, like make it fun, achieve your milestones because it takes a lot of discipline, consistency, and hard work to get to where you want it to go. If you don't, maybe if your banking app maybe doesn't have a calculator for you in terms of calculating your expenses, there are some that you can download off of your Google Play Store, your Apple App Store. You download a budget calculator or spending calculator. And if you're old-fashioned and maybe you like to be hands-on, you can put together an Excel spreadsheet with 4 columns. The first one is, what's your after-tax? Okay, the first one is The first block will look at your income. What is your after-tax income? What is your budget according to the budget rule? The third column will be what did you actually spend? And in the fourth column will be the difference or the discrepancy. Where you see a discrepancy, highlights, and those are the areas that you need to start working on. That's for the income portion. When it comes to the expense portion, it's very same thing. First column, list of expenses, the names rather. Second column, the budget you're supposed to follow. How much am I supposed to spend on each of these line items? Third column, what did I actually spend on these line items? The fourth column, what is the difference? Wherever you see the difference, you highlight, because that means that's your problem area. Those are the areas that you need to work on. And it goes for the smallest things. If you bought airtime that maybe you didn't account for, that's something you need to look at. If you contributed more towards your family because of family responsibility, that's an item that you need to highlight. And then you need to have those conversations with the family. Telling them, you know what, I earn this much, or if you're not comfortable telling them how much you earn, this is how much I can afford to contribute. Over and above this, it will be dependent on whether I've made an extra income in the month, whether I've gotten a bonus. But if I haven't got any of that, I'm sorry, I cannot contribute over this, because you're putting yourself in a predicament that leads you to a place where you are over indebted. And then I think in closing, I just want to say, when you want to make a change in life, while identifying where you are, that's your starting point. You need to understand that honesty is better than modesty. So you need to be honest with yourself about your spending patterns, honest with yourself about what you can afford, honest with yourself about where you are. So you start from the place of honesty, because it is only from that place of honesty that you can help yourself or that you can get help. If you're lying to yourself, you're just going to stay stuck where you are. But if you want 2025 to be a year where you've adopted the best spending habits, and it starts with you being honest about what I can afford, what I want, and if what you can afford versus what you want are two worlds apart, then that's a responsibility to you. What more can I do to make extra income so that I can get to where I want to be? And whilst I'm not where I want to be, I need to ensure that I stay within my limits. And that's it. I don't know if there are any questions. But when it comes to investing, maybe if you've never invested, these are some products I'd like you to look at. I'm not going to mention any where you can get them. I'm just going to mention the type of products that you can go and do research. If you don't have a retirement fund, the retirement fund is basically saving, putting aside money today so that you're able to fund yourself when you retire. A lot of people haven't done that. And so if your employer doesn't currently offer that, you can take out a retirement annuity. So you can look up an investment company or financial planning company, or your bank rather. The first point of contact can be your bank, because every bank has a financial planner. You speak to them, and that's where you start the retirement annuity. If you don't have an emergency fund, you want to start building that. It doesn't matter the amount, it's about building the mindset where you are consciously aware of the need to save. So you open up an emergency fund, and you can invest the money in like for example, at FNB that I bank with, there's a savings pocket. So you could use that savings pocket as your emergency fund savings account. And then every month you just transfer money there. You're slowly building up your emergency fund. Another great financial product is a tax-free savings account. I love the tax-free savings account because it's the only investment vehicle that I'm aware of where you don't pay any tax. So any growth, income, dividends, capital appreciation, any type of that, it's not taxed. So that's a very good tool if you are worried about, you don't want to be paying unnecessary tax. It's a good place to start. And all of the banks offer it, investment companies offer it. So you can just research, do your own research, or get in touch with the financial planner, using your bank as a starting point, maybe, or speaking to friends that have financial planners for you to get some guidance. And yeah, that is it from me today. I hope I've helped you, even if it is just a little bit. I tried really hard and I had limited time. So yeah, I don't know if there's any questions that anybody has. But yeah, that's it from my side.
Mona, thank you so much for that. There are questions, but we're going to leave it for a little bit later on. We're going to have Martinus jump back on, and then we'll go into the questions.
Okay.
Thank you.
Cool, guys. Sorry about the previous one. Technology is sometimes a blessing as well as a curse, right? Just to sort of quickly recap what I've already said, I've got more or less an idea where I fell off, but we had two different circumstances. One being this very wealthy farm owner that has a massive asset of 80 million Rand plus, but the farm does not generate enough cash to literally put food on the table. So they had to sell off vehicles, machinery, etc., just to literally put food on the table. And this was sort of a process that started throughout the pandemic. And then you had your second family, that's your more normal middle class family. They've got their medical aid, they've got their gap cover, and a family member fell ill, needed cancer treatment. So how it works is there's certain scans, procedures, and admission costs that you have up front. And then from that, you can only claim back afterwards and receive that money back. But the most important part is you need to have that cash at hand immediately. So in his case, it didn't help him to have a property, two vehicles, a large retirement annuity, because he needed funds immediately. Same with the farm owner. The asset value of 80 million Rand could be 300 million Rand. If he can't service his short-term debt, if he can't afford to literally run the place, the asset value becomes almost unimportant. So I think my goal, before we again start with the differences between savings and investments, is to say that whoever you are that's listening to this or viewing this, whether you're in a senior or junior position, whether you're old of age, still young, whether you feel as though you are financially affluent, or if you are financially strapped and struggling, really savings is for everyone. It does not matter what life stage you are in. If you've just started out in the workplace, or if you are already retired, in all and every circumstance, you do need a buffer to fall back on, because life will happen. We've seen emergencies, we've seen people losing their jobs, pandemics coming through. For all of those things, we need a short-term vehicle to tap into, to say, I need funds as soon as possible. And let's start with the differences then between savings and investments, because savings is typically seen as a time horizon of 1 to 3, maybe even 5 years. It's short-term orientated. It's for emergencies, like we've said. It's for vacations. It's if you lose your job. It's if you need to move. It's for pandemics, those type of things. Accessibility, very important. Again, it needs to be a vehicle such as a fixed deposit account, a unit trust, or a money market account, where you can pick up the phone and say to your intermediary, listen, I'm in need of X amount. This is the reason, and I need the funds within a day or two. That's the reason for that. So when we look at the other side of the spectrum, being the investments, see this as your wealth builder. These are the things that must carry on in the background for a long period of time, usually 5 years plus, but actually really longer duration, such as retirement planning, it's tuition for your kids. And although these products sometimes are in their own way accessible, in your mind, it shouldn't be accessible. This is not the place where you, if you need, for example, new tires on your vehicle, this is not the place we tap into to extract funds from. That would again be your savings side of the equation. So these things run long term. It's to look after you in your all day, or to make sure that you've got sufficient capital for your medium to long term needs, such as, again, like we said, tuition for your kids. But the point of today is educating everybody on savings. So just to distinguish between the two. So I see savings as an emergency fund. I see it as a vehicle where I can tap into that protects me. It protects my family. It ensures that we remain financially sound no matter what life throws at us. And because we've got this solid foundation where we can now build wealth from, the foundation being the savings, it does sort of alleviate a little bit of stress, knowing that life can come with a curveball or two, and we'll be okay. But it also gives us opportunities to say, if my workplace tells me that, Marnus, you need to work in Cape Town from now on. I'm from Pretoria. I need to obviously relocate myself in order to keep my job, quote unquote. And again, an emergency fund is the ideal vehicle to capture those opportunities as well. Again, we don't want to be touching our long-term investments, because that's for a specific purpose, for a specific goal. So we don't want to come into the temptation of touching those funds at any given point in time. So I guess, sort of to consolidate everything that I've said, that you might be the wealthy farmer listening to this, you might be the middle class citizen, and you think you're okay because you've got your medical aid, you've got your things in place. But I can ask the question to anybody: did it help the farmer to have an asset worth 80 million rand? Did it help the middle class person to have property, 2 vehicles, medical aid, gap cover? No, nothing of those things helped the people we spoke about. If they had a short-term emergency vehicle in place, then of course I would not be presenting on them today. So although this subject tends to seem very boring sometimes, it is quite necessary as part of an holistic overall plan. Because like I said, you can build all these fancy things outside of a savings account, and it can be one thing that rips the rug out underneath you because you didn't look at this first. So again, might be a little bit of a boring thing to talk about, but it's very, very, very necessary. I can't emphasize that enough. But now that you understand a bit more of why you need to have a savings account in place for the various reasons that we've discussed, let's talk about some smart saving strategies. So I've got a couple of them for you here today, but 3 of them, in my view, are the most important. So the first principle is paying yourself first. It's setting automatic debit orders that go to a savings account as soon as your salary hits your bank account. Do not delay. It's what we all as human beings do. We start playing this game where we say, as soon as I get my bonus, I'm waiting till another increase. If I've paid this thing off, but life again happens, then you need another thing, and you're going to get caught up in this vicious cycle where you keep delaying certain things. And that brings me to the second principle. When should you start that automatic debit order? Well, technically the best time is yesterday, but the second best time is today. So as you sit there today, over the weekend, go to any provider like the previous speaker mentioned and set up an automatic debit order that goes specifically for savings. Another great vehicle that you can have this emergency fund in is if you have a residence and you've got an access bond. Okay, you can save your emergency fund or your short-term savings in your access bond, because it will do 2 things. Number one, it is accessible. So should you need it, you can literally go into your banking account and take from your access facility. The second thing, what it does for you, it fights the interest that you pay on your bond. Because you've got extra funds there, it fights off the interest against the loan for your bond. But otherwise, if you are not a property owner, any short-term vehicle where, again, rule number 1, you need to have accessibility to that investment vehicle, you can go and set that up for yourself. And then a key principle to live by for everybody is, it's not about how much you earn, it's what you keep. It's what, after you've paid everything, what is left. Because if a person earns quite a bit of money, but they spend everything to service debt, to pay for lifestyle, they're really poor. Although they earn quite a bit of money, technically speaking, they are poor. And the same goes for the very diligent person that might be a low income earner, but he saves the bulk of his salary. That person in real terms is richer than the one earning more money. So how much you earn is not important, it's how much you keep behind. Those three things: paying yourself first, starting technically yesterday but today, and then keeping as much as your salary left over, are the 3 most important principles to live by. And then if you're a structured person and you want to make use of a certain strategy, the 50-30-20 budgeting rule that was already discussed by the previous speaker, that's 30%, 50% for your needs, 30% for your wants, and 20% towards saving. That's a structured way of doing things. Another way that, and I mean, I'm guilty of this because I am a financial planner at the end of the day, but setting SMART goals, but using SMART as an acronym. Okay, so SMART stands for specific, measurable, achievable, relevant, and time-bound goals. So it's saying that if you follow this SMART philosophy and you set up specific goals, measurable goals, achievable goals, relevant goals, and attaching a timeline to those goals, not only will you easier achieve those goals, but it will also keep you accountable and put some sort of meaning behind what you're trying to build. So again, the acronym is SMART: specific, measurable, achievable, relevant, time bound. Okay, and then make it fun. Use apps. 22/7 is one of them that will help you budget and save. You're almost gamifying the whole process. And then secondly, something that's very underrated is what you call a round-up app. So what a round-up app does is, let's say you swipe your card for 42 Rand, it will automatically round it up to the nearest 10. Okay, so say that's 50 Rand. It's an 8 Rand difference. That 8 Rand, the app will automatically take it and then invest it on your behalf. So you're saving little by little, but you're not really feeling it as you go along. And obviously you will have the power to choose, is it to the nearest 10 Rand, 100 Rand, a fixed amount, etc. But a roundup app is a very, very innovative sort of tool that you can use to save a little bit more without feeling the brunt of it the whole time. Then in your mind, like we've discussed with investing versus savings, where should I save? How much should I save? That all depends on, it all goes back to creating different buckets. Ideally, these buckets should not be managed in your mind. We are human beings. Ideally, this should be a mapped out plan where you say, I've got a bucket that's my emergency fund. It's in my home loan. Like we've said, it's in my access bond, I should say. This is specifically if everything hits the fan, right? This is if I lose my job, it's 6 months worth of my salary. I've got it for that specific reason. I'm not going to touch it for other emergencies or vacation or other short-term needs. That is the one that keeps my family stable. Then your second bucket could also be short-term of nature, also be accessible. These could be something you're saving towards, whether it's a mindless want that you've got. It's okay. But having separate buckets with separate goals attached to it help you, again, stay on course with your financial plan. And then very importantly, it's tough, I think, if I have to think as a consumer with all these various products. We all are different ages. We've all got different circumstances. Where do I start? With what do I start? What is the right vehicle, etc.? So having a financial soundboard, I almost want to call it not a financial planner. The financial planner should be a financial coach in your life. Somebody that you can say, let's climb onto a meeting, and then hopefully the Zoom doesn't crash again, but let's get onto a meeting. I've got this funds. This is my budget. This is my circumstances. Please help me with a starting point. Map out a financial plan where we say, okay, right now, 2025, January, this is where we're starting. But person XYZ, we need to get you from year to year. So in June, I'm going to see you again. I'm going to keep you accountable because in June, we need to start this new thing. And then next year, we can look at long-term planning. And that's really why you need somebody in that position to not only keep you accountable, but to keep track of your goals and build a financial plan as you go along in life. And as all of you know, no doubt your circumstances will definitely change as you age and go through the different life cycles. So it's very important that you've got that person sort of standing behind you, guiding you through the different life stages that we will go through. But yeah, like I said, to consolidate everything, you can come up with all the clever strategies in the world and invest in all these fancy investment products. And you can have a strategy to buy different properties. You can have a business. All of those things are fantastic. But the same analogy that we all know is that you can't run before you walk, and you can't walk before you've crawled. Now, this is the crawling step, but it's the most important thing, because if you skip the crawling step of saving and ensuring the financial stability in your scenario, you might as well forget about walking and running one day. You don't want to be building things up that just falls flat eventually. Right, I've assisted with smart saving strategies and to get you guys going.
Maurice, thank you so much for that. Colleagues, I'm battling with my camera for some reason. It's not coming on, but it's okay. I have a question for both Marnus and Mona. Maybe both of you could answer, or it's just, the question is, with salaries increasing, sometimes under inflation, and with two core elements that adults cannot run away from, being medical aid and school fees. Do you still think that it's still what's the question? Okay. Do you still think it's possible to save according to the criteria that you both gave, the percentages? Because, medical aid and medical aid and school fees is actually a non-negotiable. So what's your thoughts on that?
You want me to go first?
Yes,
Yeah, happy for
please.
you to go first.
All right. So what I've noticed with this is we all feel it, right? Again, if it really doesn't matter what position you're in, we all have certain obligations that we need to look after. Some of us, I call it the hamburger generation, where you have to look after kids as well as your parents. So we've all got different scenarios and things keeping us back from just simply saying after this conversation, let me save 1,000 or 2,000 rand a month. But really, I'd start at the basics in terms of that. I will go and map out in any which way and form you want. I can explain mine perhaps. So I don't use any formalized budgeting apps. I've got a spreadsheet that I run myself and I split it. It's very easy. So what I do is I look at all my fixed expenses. And Netflix and those things are nice to have. It's not a fixed expense. It can be cancelled at any time. So all the things that you cannot cancel. So I go and rank them. That's my property. It might be vehicles, medical aid, like we said, those things, right? Those are the things, if the pauper had to strike the fan, and I only have to pay, that's the way you can think about it. I only have to pay these things. Though that comes under the essential tab, and you monitor those things. And in places where you can review those things, such as a medical aid, I mean, there's many providers out there. When last did you see a proper medical aid financial planner to do a needs analysis on you to see if what you pay is still relevant for your specific family? So reviewing some of those items are possible, then splitting it up to say, okay, I've got other things that I need to pay. And I like extracting things like Netflix, gym, those type of things, which technically speaking, I can cancel it tomorrow. Cell phone contracts. Nowadays, everybody wants to walk around with the latest iPhone. I just don't believe in that. So looking at cell phone contracts, looking at anything that you can still have, but scale it down. And then moving on to the miscellaneous. These are the things that we have to go back and review in our budget, saying, but okay, I'm thinking I'm spending 1,000 rand on eating out, but I'm actually spending 1,005. Okay. I've had an emergency twice now. It might be a different emergency, but it cost me an extra 1,000 rand in my budget. Those things need to be extrapolated, and you have to ask yourself the questions, but why am I paying this from my cash flow? Okay. So only once you understand all the money that's coming in and all the money that's leaving your account, okay, and not just flying through it, understanding what comes in, what goes out, the variables, the fixed expenses, etc. From there, I'm pretty sure every person I've ever seen in my life, there are space to improve on once you look at your budget. It's just removing the ego from it, understanding that I perhaps don't need to drive a vehicle that's in excess of 500,000 rand, because you don't. You don't need to have the latest iPhone. I'm pretty sure you don't need to have Netflix, Disney Plus, DSTV, and all of those accounts, which nowadays most of us have. So really re-looking the entire scenario, that's the first place where you will learn that there will be some money that you can now allocate towards savings. And then from a salary perspective, not going up with inflation, I think most South Africans are in the same position there. That's not something that I can per se help you with, but again, we need to fight fire with fire to look at our expenses then. And then thirdly, if you are in a position where income becomes a problem, you've now narrowed everything down. My recommendation, I'm assuming the time will not be enough today, but although we spoke about debt, there's good debt and there's bad debt. Bad debt, that's your credit cards, those type of things. So as soon as you formulate a strategy, paying those high interest loans off, that can now be allocated towards savings. Instead, what the usual person does is they'll pay it off and they'll just go into new debt or buy something else with that capacity. Wrong. So that portion must go towards savings. But then the good debt is where you teach yourself. Remember, the best investment will always be in yourself. Let me tell you that. So it's a case where now we understand where you are with your salary, but now you need to look at debt differently. You need to look at debt as your friend, and debt can help you build assets if you do it properly, structurally, with the advice of a financial planner or lawyer or accountant or whatever. So do it structurally sound and make use of debt to build you assets, because that can now stretch further from your own capacity to save, because now you're using debt and you're using other people's money to build up assets. This can be businesses, this can be property. But yeah, so I hope I've handled the place where you need to start, the basics, which is the budgeting side of things. Again, can't help you with if your salary does not increase by more than inflation. Fire with fire, cut your expenses, and then secondly, look at alternative strategies of creating wealth, for the fact being that your salary is not increasing by more than inflation.
Marnus, thank you
That's
so
good.
much. Yes.
Yeah, I just wanted
Marnus?
to chip in.
Yes.
I think he basically touched on all of the technical aspects, and I 100% agree with him. I think what I wanted to add is going back to what I had mentioned. If you find yourself in that situation, it's often a thing of you need to now have an honest conversation with yourself and your family. If you need to downsize, sometimes those are the decisions that you need to make. I like the terminology that he used, fighting fire with fire. Income is not increasing at the same rate that lifestyle is increasing. And that's a fact. We can't change that. That's out of our control. But what is in your control is now, like Prince Mario, said, it's re-looking at how much you're bringing in, looking at how much is going out, and you need to now start cutting off what you don't need. You need to make that tough decision. You need to have those tough conversations. If it means getting a car that's more affordable, then that's a decision you need to make. If it means looking at alternate Wi-Fi offerings, then it starts with the smallest things, but then they compound and make a lot of difference. In isolation, it might not seem like it does much, but when you look at the compound effect of it and the aggregate effect of all the decisions you make, over time it starts making sense. So it's just about having honest, open, and transparent conversations with yourself and those you care about. Yeah.
Mona, just one question that is for you. One of the a question in the chat box is it true that if you go under debt review, that you will never get credit again?
It's not that you will never get credit again, but the truth of the matter is that looking at the success rates of people that have undergone debt review, you find that the biggest problem people have is discipline. And so it's not that the process doesn't help you, but that people never get to the end of the process. So it would take time. Like the last time I had a conversation with the person that does debt review, they mentioned that it takes 10 to 15 years for that mark to be removed from your name. And people are told, no, it can take 5. No, it's not a 5-year process. It can take 10 to 15 years. But that is for someone that has discipline. And so that should be like the last resort. Yeah, that should be the last resort. If you can try to make a plan to not get to that stage, I would highly recommend that. But if you found yourself in the position and there's nothing much you can do, then that is an implication that you need to face for as a consequence for the actions that you took. And that's why I'm saying fight, and that's why Mario said fight fire with fire. You need to be tough with yourself, because if you find yourself in that kind of predicament, you're looking at 10 to 15 years. And that's tough. That's really tough. And it doesn't only impact your credit score, but if you're a professional, for example, in my field, it might jeopardize your ability to continue practicing. And then all those years of hard work is gone. It doesn't just impact your credit score, it impacts your ability to earn an income in the area that you studied or in the area of expertise. So there's a lot of implications of having that against your name.
Okay, thank you. I see Casper's hand was up. Casper, can you come through? Maybe you have a different perspective on that specific question.
Yes, Alicia, just on my background, I've been a debt counselor for over 15 years. I'm also on Debt Counselling Association South Africa on the NEC, the National Executive Committee. And unfortunately, I think Mona needs to have a couple of minutes with me afterwards that I can highlight and educate her. I also sit on South Africa's Credit Industry Forum together with the major banks and all of that. And yes, maybe debt counselling back when it started wasn't the best, because nobody had an idea how it worked. But if you look at the South African law, and I've got a legal background as well, it's the only thing in our law that actually allows to expunge any negative data off a consumer's credit profile. So meaning when a consumer is done with debt review, their credit profile actually goes back. While under a yes, you cannot obtain further credit. However, afterwards, it expunges any negative data in regards to those accounts, and within 21 business days, you can apply for credit. Now, even with DCGSA, our internal stats show consumers with bonds and vehicles, on average, when doing yearly reassessments and increasing their payments, paying off that debt, just like Marnus advised earlier, is to deal with your debt before you can save. And back to the consumer's question, once your debt is gone, you'll have efficient money to start saving. Hence, a debt counselor and a financial planner should actually work hand in hand with the consumer's finances. Now, our average consumers within 38 months, on average, having a house, having a car under debt review, actually exit the process. And we've actually ran a pilot project about in 2023 with two of South Africa's major banks, and 163 of our consumers that obtained clearances opted in, where they either wanted to finance a house or vehicle. And all 163 of them got that finance afterwards. And I think the worst interest rate a lady got was at prime minus 1.2% on a vehicle. So yes, if debt review is utilized correctly, it is one of the best tools to get rid of your debt, allowing that extra capital to start savings, to start investing, and to start creating wealth. You know, I always think back of one of my consumers that I assisted back in 2010. He finished with me in 2013. And why I'm mentioning this consumer is he was an assistant teacher back then. And he earned peanuts as assistant teachers do. And when he finished with me, he said, Casper, what can I do to become wealthy? You know, I come from a background where I need to take care of my parents. I'm the only one working in my family. How do I actually become wealthy? And I said, well, you know, rule of thumb is any extra money, start investing and start putting that away. And at least 40% of your income, start putting it away. If you're willing to live like a pauper now, you can invest in your future. And every year, November, like clockwork, I get his financial portfolio emailed to me, just to tell me how it's going with him. And he's now principal at a school, earning a substantial amount of money, but his investment income, his investment interest is 5 times his net salary, only 9 years or 10 years almost now later. So it shows you somebody that as receive the financial tools, been helped correctly through a debt counsel, through financial planning afterwards, can really get back on your feet. And any South African can do it if we are willing to step back and say, listen, I don't want that latest iPhone or Samsung. I don't want that immediate gratification. I'm willing to step back. I'm willing to start investing in my future. And then, yes, medical aid is going to go up. Everything's going to go up. But if you're willing to take that step, put that budget in place, start cutting back, start getting rid of your debt, your future is going to be prosperous.
Casper, thank you so much for that. Lovely to have different perspectives. It really helps. I think Martinus, Mona, and Casper, you've given us such different perspectives, similar but also different perspectives. And I think it's up to us then to take it all in and make better decisions, so to speak. Colleagues, our last speaker is Surprise Choshi, who is a who runs a business advisory service company. She's a qualified accountant and tax practitioner with a BCom auditing, taxation, and management accounting degree. And of course, someone like this, I think every one of our member companies, because you own businesses, you either startups, entrepreneurs, small to medium size, businesses. This is the type of person that every business needs to make sound business decisions and also to stay abreast of all your SARS and tax related matters. So without further ado, can Surprise come through?
Good day, everyone. Thank you so much for such a very nice introduction. So today I'm speaking on strategies for businesses, right? And the other previous speakers have laid a very beautiful foundation because the one key thing that is a problem for a lot of businesses, specifically SMMEs, it's actually the cash flow. So today I'll be discussing some of the two pillars when it comes to cash flow in business. I'll be going through a discussion of understanding your target market. I'll also be going through the discussion of actually understanding your compliance in business. So the first one, why would I even touch on the issue of target markets, right? So understanding your target market as a business is going to set you up for success. Cash flow being a major hindrance in a lot of businesses, you find that when you don't understand your clients pretty well, you're going to find yourself stuck at some points with cash. For example, let's say you run a business and some of your clients they have other cash commitments that they are not able to pay you in time. Those are the considerations that you need to have when you making sound decisions for your business. For instance, now when you understand your client clearly, you know that this is my client, these are their habits. We would also understand because as accountants, you'd find that you have that one client who has a certain lifestyle and they are falling behind on certain payments in life. You become patient with them. You walk through the process with them in terms of how do you better build financial management in your business so we don't desert them. However, it is important that even when you know that your client might not have good or sound practices when it comes to financial management, as a business, you need to learn how to protect yourself. What do we mean by saying you need to know how to protect yourself? It means that even though your clients might not be able to pay you in time, you need to normalize building up savings so that when your clients are not paying on time, you are able to dip into those savings and afford your expenses. The most unprofessional thing for a business is for you to say you don't have the money to meet your expenses. And imagine a company that you're relying on for you to provide a service and they're telling you that they are not meeting their expenses. So that is the most important thing. Once you have an understanding of your client, you now are able to put into practice certain things. For example, what a person could do in business is this. Let's say now you are having a client coming in. They are looking for a service. And when they are looking for a service, you are already having a picture of some of the problems that they are struggling with financially. What you can then do is to split the payment, right? So you can tell a client to say, I'm going to need this amount of money, non-negotiable. I'll need this amount of money. You could split it 50-50, depending on your own business needs. You split it in a way that you are able to cover your own commitments from when this client pays you. You know that the other 50% might not come at that time, but you have laid that foundation or a policy that allows you to protect yourself against clients who are not paying you on time. And also, you could look at the timelines that you give your clients to say, without compromise, I know we're a business that cares about actually assisting clients. However, I cannot have you falling behind on your account for 2 months. I can work with a month. So when you now understand that you're going to have a client who's going to pay you on the second month, then your goal becomes to going back to your target market. How can I then secure more clients in this timeline so I'm able to meet my operating expenses? Because the reality of business is that you might have provided a service, but you don't get paid for that service on time. So what happens then? Because you have your own commitments, you have people to pay, you have other bills in the businesses that need to be settled, and you are not getting paid on time. So understanding your target market is a major thing that I cannot emphasize enough. So if you do need to sit down with someone, have a sit down with someone who can better advise you to say, these are all the different clients that you're having in your business. All these different clients, they have different attitudes, they have different behaviors. So once you understand all these clients, you tailor an approach to them. But the most important thing becomes how you then collect money to your clients. How do you cater for the inconveniences of not receiving the money on time? This now, it is not something that happens overnight. So you'd find that you are struggling, but it's a work in process. So every time you are going to go back, reflect on what has happened, you check which client is struggling to pay. And when your client is struggling to pay, you sit and you have honest conversations with your clients because sometimes their own financial cash flow issues, they are not something outside of their control. Perhaps they are not budgeting properly. So then you sit down with them and you actually assist them because the most important thing that a small business can have is its network. So you don't want to be so quick to dismiss your clients when they are not paying you. You want to be patient with them, but also assert your boundaries in terms of where does this end? So that is very, very important. When you understand your clientele, you understand your target market, and you know that actually there are certain clients that you'll know that this client never pays on time. And that's okay. You try and talk to them and get to the point of paying on time. But the important thing is are you able to recover the money that your clients are incurring as they are buying your products and services? Because you also don't want to be producing or providing services that are not being paid for. So that is a very key thing when it comes to business and your cash flow. And when it comes to the issue of credit, we need to be very realistic about providing credit. Sometimes you might have to turn away a client who's unable to pay because when you have to provide a service or you have to sell a product, you need that cash to meet your obligations. We need businesses that are sustainable. So you would rather maybe lose one client for you to be sustainable and provide more services to other clients. So when you are in no position to provide credit, do not even think of providing credit. When you're in services, your time is your money. The time that you're using to provide a service instead of marketing to get other clients, that is time that you have lost and it equates to the money that you are losing in business. So now it also now affects your cash flow. When you are looking at the month end and you're consolidating everything that you've worked for, you start to realize that you have a shortfall in that month. And that shortfall came from when you provided services or you gave out products on credit, whereas you couldn't afford to. So at any point in time, you need to be in touch with what you can do. You need to be very realistic. Yes, it is painful to set some boundaries when it comes to your clients. So this discussion is solely based on your client, there's obviously other factors to consider, such as the fact that as owners, sometimes you might dip in, of which other speakers have spoken on this to say you need to be very disciplined. So hence, I'm not touching much on that. So this one, when it comes to your clients, you need to have good policies in place, ensuring that the relationship you have with your clients is a sustainable relationship. And a sustainable relationship looks like it continues for years and years. It's nice to have a client come in, purchase a service and go. You've gotten the money. But a business that is sustainable has constant income that is coming in on a monthly basis. And what better way to have constant income than have your clients that are on a retainer? To have clients on a retainer means also accepting them, but you accept them within your boundaries as a business. You know how much loss you can incur. So once you've figured out how to collect that money from clients, when to provide credit and when not to provide credit, you are able to ultimately save to now have your savings. In business, it is advisable that you are at least having your 3 months expenses up ahead, just in case there's any clients who are not paying on time. If maybe there's any business disruptions, a good example would be COVID. It came when we least expected it. We didn't know anything like that was possible. We had a lot of losses within the country, and the economy is just trying to recover now. So now it becomes very, very important that you are aware of these things and discipline to talk to your clients. We want to keep clients, but it's important to be that disciplined. Another factor to consider when you are thinking about the financial obligations that you are committing your business to, you need to think of where in your business are you? There's different stages of business, right? You could be in the ideation stage whereby you're just simply starting out. You could be in a state where you are a startup. You could be in your growth stage, expansion. There's different stages, right? And those different stages, they also inform what financial commitments that you can make in your business. If you are starting out, the best thing you can do in your business is to try and fundraise in ways that do not include credit. As the previous speaker spoke, there's ways in which in your business you can leverage credit to grow, right? But when you're starting out, it's not the best idea. So it's for businesses that are looking to expand. That's when we do something called gearing. We're looking at you, oh, you have this much cash. You need to also have debt to match the cash. So that's basically important to remember who your target market is, understand them, your target market, and truly accept them within reasonable boundaries of your business. And remember where your business is. Yes, you might make a comparison. There are other larger companies who can do that. So sometimes we have blind comparisons whereby we are saying, but this company can provide incentives. Is your company at a stage where it could provide incentives? And if the answer is no, then you walk your path, you walk your journey in your company according to what your company can provide. So if your company cannot provide credit to clients, you do explain to clients that unfortunately, this is what it looks like. If I do provide you with the credits at the end of the month, I'm not meeting my obligations. Is there a way that we can collaborate or work on this in such a way that I don't lose you as a client and I also get to meet my obligations as a business owner? So those conversations are important. And in my years in business, we've not lost the clients because of such conversations where we sit down, we are also vulnerable to say, listen, you're a good client. I wouldn't want to lose your business. How can we both win the situation? And that only comes from the conversation you sit down with your team and have about who your target market is. And now you tailor an approach to them in terms of how do you retain them as your audience now. So now I've spoken about the importance of that. In closing, I'll talk about compliance. The reason why I started with the target market, yes, our line of business is very important, but a lot of business owners, they struggle because compliance is something you need. It's not something that is, marketing. You see money from marketing. Marketing is fun. So that's why I started with something along the lines of marketing. Now, when we consider compliance, compliance is something that could dismantle your business, everything that you've worked for. If you are not compliant with the bodies that you are registered with, if you are not compliant with CIPC, if you are not compliant with SARS, that is a big thing. So I would say businesses, when they are looking at their financial commitments, they also need to consider, because a business can run the whole year without any considerations for tax. When the time comes to file taxes, the business is not ready for that. So those considerations should be there. Considerations of what commitments do you have that are legislated, that are by law. You see, if you know that you have a registered company, you will be liable to pay your annual returns on CIPC. If you have a taxable income, you will have to pay tax on that taxable income at SARS. So those are the things that businesses sometimes they neglect, because it's a second thought. You know the importance of compliance, but because it doesn't directly translate to sales, it's a bit hard for businesses to focus on that, because the pain point is actually finances when it comes to business. So these things, even though they are financial obligations, they are only financial obligations at a later point. So a business will want to now deal with that financial commitment when it occurs. And now, when it's occurring, you don't know how much it is. What if we calculate your taxable income and it's putting you at 100,000, and it means you have to pay 27,000 rands in tax? So these are conversations that business owners should never avoid. So I would suggest business owners what they can do on a separate page that they can hang in their office somewhere. They must write down all the statutory bodies that they are liable to pay money to, and they just hang it somewhere where they can see, because this is something, in as much as we say it's important, it is not money generating, and it becomes the last thought. It becomes the last thought because, remember, in business, you need to generate money. So you focus on your clients, you focus on delivering a good service or product to them. And this one, when it comes to tax, you'll find it probably when you have an application and you're like, oh, my tax return, did I do it? Do I have a tax compliance? And now you're suddenly panicking. So because I know it's things that are very at the back of our head, hence I say just have a piece of paper that you've written, have it pasted somewhere where you can see, so that you are reminded to say, I'm going to have a tax obligation at this time. I will have to file my CIPC at this time. I will need to pay this so and so body at that time. So that is basically what I had for the audience today. I will just hand it over to you, Alicia, to continue with the program. Thank you.
Speakers, thank you so much for your time. That was such valuable information. There are no other questions in the chat box. I think your presentations and your answering of the questions have answered everyone. As I said, thank you once again for your time. We really appreciate it. All our members and colleagues on the call, thank you very much for your time. If you have any questions whatsoever, you can always pop me an email, and I will do my best to get those answered for you. We have come to the end of our webinar today. Thank you to all for your attendance, and to our speakers once again. Thank you and have a blessed day. Bye-bye.